If silver went to $200 an ounce, it would not surprise me in the least. And frankly, if you go back in real dollar terms, to match those highs in real dollar terms, we'd probably have to be $200, whereas gold has been driving north. Will it, in fact, provide an alternative to a breaking stock market? And we're open to that, although I think any rally that T-bonds do produce as an alternative will be short-lived and dangerous to participate in for the long haul. But right now, the only alternative is gold and the gold miners. In fact, the gold miners are beating the S&P. If you go back and look 1 year, 3 years, and yet nobody knows that.
In today's news recap, silver holds strong momentum. Silver prices were at $37.7 per ounce today, extending the strong momentum since the start of the year amid signs of robust industrial demand and the outlook of rate cuts by the Federal Reserve. China installed over 93 gigawatts capacity of solar panels in May, a 300% surge annually to a fresh record high before a new set of policy changes would make it more difficult to attach panels to grids. Additionally, the State Grid Corporation of China stated it would exceed $90 billion in grid investments this year to prevent curtailment of solar power, set to ease concerns of future demand for photovoltaic panels, which are silver's main industrial use. In the meantime, the lack of aggressive upsides in the latest CPI report drove markets to pile on bets of a rate cut by the Fed in September. This, combined with the impact of pessimistic ISM PMI results and the downward revision in non-farm payrolls supporting bullion assets without yield. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
That risk of the index, and we know what those symbols are, all the big names. And the S&P has it has those symbols also up front, the S&P 500, but not weighted as heavily as the NASDAQ 100. So while the S&P's gone up about tenfold since its 2009 bear low, NASDAQ 100's gone up about 19-fold since its 2009 bear low. So we got 15 plus years and that kind of metric of growth in price. No time in U.S. stock market history, the last 100 years anyway, has that occurred. Duration and dimension. If you look at an M2 chart, or if you look at a Fed funds rate chart, you'll fully understand why it occurred. They pumped money, they had free money for 10 of those 15 years. And the money growth, which is now accelerating again, they're trying to save things, the things they think should be saved. The problem is when they get to that point in the stock market, reality takes over and you bust the bubble, the psychological bubble. It takes over. Reality wins. Policy of government doesn't win. It fuels something else like it did in 2000, 2002, 2007 and 2009. It fueled gold. It fueled T-bonds then. So I'm looking for that again. But the leader on the downside this time will also be the NASDAQ 100, the tech sector. In fact, if you go and look inside the market, and we all hear, the market's making new highs. Well, it is, it isn't. Small caps, Russell 2000, nowhere near its highs. In fact, if you look at the Mag 7, so-called, we're down to like Mag 3 now. It made new highs above the early 2025 highs. Apple didn't. Amazon didn't. In other words, we're losing our leadership even. Anyway, I think we're in that position now where the leadership is, if you examine internally, it's not what you think it is. And this rally, momentum-wise, from our long-term momentum analysis, not looking at price, is broken. It broke during the January through March, April break. This rally, though it's to a new marginal high, I'm talking 2, 3, 4%, above the January high for the S&P and NASDAQ. is not at all confirming with momentum. Momentum is still very weak looking. In fact, if you saw the momentum chart, you would see this uptrend that was broken in early 2025, hence the drop. And this rally on momentum is up on the underside of that structure that it broke on momentum. On price, it's nudging a new high. On momentum, it's bumping the underside of the bridge that it blew up. So momentum says do not trust price. And the only thing I'm kind of looking for now is that tombstone event where they finally get what they want. They get a Fed rate cut and they know more is coming. Then that's when the shock occurs, because once that occurs, if the market starts down, that's when doubt and panic set in.
Got it, Mike.
It's already broken out. We had a corrective, really a sideways process. If you go back last year, remember gold in 2021, 22, 23 was a sideways market. It kept going over 2,000, they'd sell it off. Go over 2,000. So first of all, gold never tops with a sideways top. Never. It always makes spike highs and you never go back to them. To hit over 2,000, and finally on the fourth attempt, which had been in March of 2024, gold broke through that, and also long-term momentum said, you're breaking out this time. In other words, you're going to wake up after this dull period. Silver and the miners during that time had been in a staircase, underperforming gold and actually somewhat correcting down with overlapping waves. Silver broke out on the long-term momentum, a renewed, let me put it this way, not a fresh breakout, but a renewal that says, I'm waking up again. When it came up through $25.26 in the month of March last year. Or is it now pushing at 40? So yeah, there have been a lot of zigzags on the way up. Now, that initial surge in April took us up to a high at $32.70 in a surge, March, April, May, okay? During that time, gold was going flat, by the way. It hit a high in April last year and went sideways, just like it has done recently. Silver shot up big. Hit 32.70. Now look what happened since May last year. Downswings and upswings getting up to $35 twice, taking out that May high of last year. October of last year, we got to 35. March of this year, we got to 35. And it fell back down again. But basically, you could draw a line sideways through silver price, through that May high of 2024. And you've been doing this, either side of it on price. That for price was a corrective 1 year sideways range, digesting its new price level, which had been in the 20s. Now suddenly it's in the mid 30s. Okay. When we came up in June, we're in August now. We came up in early to mid June. We got up over 34 again, and our momentum said, okay, you're going to blow out of this range. So you asked for a breakout. We had it. The breakout occurred when we got up approaching 35 from the underside in June, a couple months ago. Still not taking out those two highs that had occurred above 35, October of last year, March of this year. But coming up toward them, momentum says, you're gone, you're going to break out. We surged. Now they're selling it repeatedly. Again, silver doesn't top with repeated highs. 39 plus, 39 plus, 39 plus. Why? They don't want a big round number of 40, so they sell in front of it. Our assessment is this breakout that already occurred is likely to drive silver well past 50 and probably into the $60, $70 range by the end of the year, if not more. But that's our estimate. For most people, that will seem like a real acceleration. There was what's going on? How come I'm not in this? Okay. And I think you're already starting to see that in the gold and silver miners. They're starting to, you can have a down day in gold and they used to be down twice as much. Now they're up, quite often. I think money is starting to flow into silver as opposed to gold, a preference there. It's shifting again. And the miners versus gold. And I think between now and the year into the year, now I'm not looking for a top then, by the way. Don't confuse what I'm saying. I'm just looking for this particular surge to reach those levels. Ultimately, if silver went to $200 an ounce, it would not surprise me in the least. And frankly, if you go back in real dollar terms, factoring in the growth in the money supply, for example, and looked at 1980 when it was $50, or look at 2011 when it was $50, to match those highs in real dollar terms, we'd probably have to be $200, just to match the real value of silver then. So, but right now, my focus is I think we're in the acceleration mode. I think gold is even now starting to hint that because it went up again into the high 34s today on the October contract. So it's indicating I'm coming up. It will lag the others though. So I want to be, again, the place to be, silver, gold and silver miners.
In today's news recap, Citi raises gold forecast to $3,500 per ounce over the next 3 months on negative U.S. outlook. Citi raised its gold price forecast over next 3 months to $3,500 per ounce on Monday from $3,300, and the expected trading range to $3,300 to $3,600 from $3,100 to $3,500 on the belief that near-term U.S. growth and inflation outlook has deteriorated. U.S. growth and tariff-related inflation concerns are set to remain elevated during the second half of 2025, which alongside a weaker dollar are set to drive gold moderately higher to new all-time highs, the bank said. Last week, U.S. President Donald Trump imposed steep tariffs on exports from dozens of trading partners, including Canada, Brazil, India, and Taiwan. The tariffs imposed last week on scores of countries are likely to stay in place rather than be cut as part of continuing negotiations. Trade Representative Jamieson Greer said on CBS show Face the Nation, aired on Sunday. Last week, the dollar weakened after non-farm payrolls increasing by 73,000 jobs last month, after rising by a downwardly revised 14,000 in June, which revived hopes of a Fed rate cut in September, with markets now pricing in an 81% chance. Per CME FedWatch tool Citi also highlights weaker U.S. labor data in second quarter of 2025. Institutional credibility concerns have increased regarding the Federal Reserve and U.S. statistics and elevated geopolitical risks related to the Russia-Ukraine conflict. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
Sector. Now, narrow leaders. And they will no doubt lead the downside. This doesn't mean that what they've been saying and expecting and the future might be is wrong, or that it's not going to happen. I mean, after all, at the internet bubbletop.com in 2000, the frothy talk was it's going to change your life. And you know what? It did. They were dead right. And yet the NASDAQ 100 dropped 82% in the next 2 years. 82%, while the S&P dropped 50%. So just because AI is real, has new dimensions we're perceiving, all this could be true, but that doesn't affect the pricing issue. Markets sometimes go too far, even though what they're chasing is true. They just go too far. They go 3 times too far, and then they exhale. And I think we'll be facing that. So I think the leadership on the downside will, in fact, be the leaders on the upside that we've seen. But some of the sectors are already exceptionally anemic, and they're pivotal sectors that nobody wants to talk about. But the banks don't look good. Commercial real estate ETFs don't look good. Too many things that are too significant to ignore don't look good. And you get me on to Bitcoin in a minute if you want to. That's an arena I think that we're predicting a major ambush. Bitcoin used to be, well, first off, it didn't really matter what Bitcoin did or didn't do 10 years ago, 5 years ago, in terms of impacting other markets. But over the last handful of years at least, especially since 2022, Bitcoin has moved almost literally month by month with the NASDAQ 100. We ran a price chart overlay a couple weeks ago just showing Bitcoin monthly futures, NASDAQ 100 monthly. And it's almost month by month. level off at a range like in 2024, early 2025. The Bitcoin had resistance at 110,000. It dropped down. So did NASDAQ, dropped down into April, turned from the April low, came up, made a marginal new high, got to 120,000 in Bitcoin plus. Now we're 117. But basically, Bitcoin and NASDAQ are identical. And I think now that Bitcoin has an institutional linkage where big money, I'm not talking foaming speculators, but institutions, companies have committed to crypto in such a way that it is now it's a vulnerable issue if they're wrong. It's not just some sideline market anymore. And when I look at Bitcoin, long-term momentum, now you look at price is one thing. You get this up wave, a down, then you make a new high, you pull back to the last high, you hold it, you go up again. It's like a staircase. I think the recent surge over 120 was probably the last spike. And if you ever get back below 110, right now we're 117, so it's not a lot. You get back under 110,000 by much. Even the price guys should start to scratch their head, because that was a ceiling late last year and again early this year of distributors. People saying, I'm out, I'm out, I'm out, I'm out. You pierce through it, don't go back below it. That will break the pattern, price pattern. The problem with Bitcoin from our perspective is the quarterly momentum. When we measure its monthly price in relation to a 3/4 moving average, we come up with a different visual picture of what Bitcoin looks like than what the price chart says. One, we're not making new highs. Price is, momentum is not. But momentum has a floor structure that is so bloody clear that it's used it 3 times since 2023. It keeps coming back down to the same oscillator level, namely around the zero line, which is to say it drops back to its 3/4 average. It holds, it holds, it holds. If you go back a 4th time, you will not hold. The similar structure to this in our momentum archives is the crash in 87. The S&P had precisely the same quarterly momentum chart. It had used the quarterly structure 3 times as support. Though price was ascending, momentum was building a floor. It's the 4th time from a non-confirmed high where price made a new high in the S&P, momentum says, you rolled over that next time. When you hit that structure, you crashed. And I can't think of a more ripe psychological market right now for a crash. And one that if it happens, and we think it's going to, the issue is at what price level. It means does it happen this quarter or next? I'll tell you the numbers in a minute. It will have wave effects. And I bet you that the NASDAQ 100 correlation to the Bitcoin chart will hold, meaning you're going to see NASDAQ 100 getting hit as well. Not necessarily a crash, but getting hit. This quarter, the numbers are seemingly far and safe enough below. 92,000, 93,000 area on the Bitcoin. If you look at a price chart of Bitcoin futures, you'll see that's only halfway back to the low we made at the last pivotal low, which was 75, 76,000. So it doesn't disturb the price chart. It blows momentum, however. But you get out 7 more weeks from now into the 4th quarter, and that number is going to jump up well up above 100, probably close to 105 or something. So again, if you slip that price back below the 110,000 ceiling and break through that old ceiling, indicating this rocket liftoff wasn't a liftoff, okay? Quarterly momentum in 7 weeks says you're gonna collapse if you drop back much below into that 105,000 area. The precise number we'll calculate as we get to the end of this quarter. The point being, when we see structures like this on momentum, it's very rare indeed that they're avoided. They're there for a purpose. So that would be an ambush psychologically to almost everybody if that happened.
What do you think of Schechtman's take? Do you agree with him? Is the big reset a reality, or is it all just bollocks? Post in the comments section down below your honest opinion and share with the stackers your gold and silver price prediction. Now, check this video right here because it's a perfect fit for you, and I'll see you on the other side.